What if you could grow your money without chasing the next hot stock? The S&P 500 makes that possible through steady, boring progress. This video explains a beginner's plan to invest in the S&P 500 with simple steps you can follow this month. It's not about risky bets or flashy tricks, it's about building a habit that lasts. What is the S&P 500? It is a list of 500 big companies in the United States, weighted by size, and it represents a lot of the stock market's performance. For a beginner, that sounds complex, but you can own a tiny piece of all of it with one fund. The core idea is to buy into the market as a whole rather than picking individual stocks. An index fund or an exchange-traded fund lets you do that with very low costs and minimal maintenance. That simplicity is your first advantage. We will outline a practical plan you can start with this month. The plan uses 3 moving parts: an automatic monthly investment, a simple portfolio target, and a set of rules to stay on track. You don't need to be a market expert to do it. Let's begin with your money situation. The most important step is to make sure you have an emergency fund first, usually 3 to 6 months of expenses. If you don't, start by saving that before you invest in the S&P 500. With that safety net in place, decide how much you can invest each month. A common starting point is a small amount you won't notice in your everyday budget, like $3 to $10 a day, which is $90 to $300 a month. The exact number matters less than turning the habit on. Next, choose your investment vehicle. For the S&P 500, the cheapest options are index funds or ETFs that track the index. Look for low expense ratios and no commissions on trades with your broker. The goal is to lose less of your money to fees. A simple choice is an ETF like VOO or IVV or SPY, or a mutual fund that tracks the S&P 500. The exact fund isn't as important as the fact that you own a broad slice of the market. What matters is consistent, long-term ownership. Now set up automatic monthly contributions. Most brokers let you schedule an automatic transfer from your bank and an automatic purchase of your chosen fund. Automating removes the temptation to skip a month or time the market. This is where the strategy becomes practical. When you automate, you're practicing dollar-cost averaging. You buy more shares when prices are low and fewer shares when prices are high. Over time, smoothing out fluctuations. You won't get rich overnight, but you steadily own more of the market. Let's talk about a concrete example. Suppose you commit to investing $150 every month into an S&P 500 ETF. If the price is high one month, you buy fewer shares. If the price dips later, you buy more. Over years, this habit compounds growth. How do you know your target allocation if you're only buying the S&P 500? If you plan to keep things simple and purely stock exposure, you can allocate almost 100% to the S&P 500. If you want a bit of ballast, you can include a bond fund for a smoother ride. For beginners leaning toward simplicity, a common approach is 100% in the S&P 500 in a taxable account or in tax-advantaged accounts. If you want to add risk management, you can diversify later with a small allocation to a bond or a cash-like fund, rebalanced annually. Rebalancing means adjusting your mix back to your target. If you only own the S&P 500, your allocation stays the same. If you add bonds or other assets, you'll update the proportions every 6 to 12 months. Don't overthink the timing or the exact moment you invest. Time in the market matters more than timing the market. A consistent monthly habit beats a big splash of money right now that you might regret later. Now, fees and taxes. High fees eat into returns over decades. Choose a fund with a low expense ratio and a broker with no trading commissions, so your dollars stay invested. In a tax-advantaged account, like a 401k or an IRA, your gains grow tax-free or tax-deferred. In a taxable account, you should consider tax efficiency and long-term holding to minimize annual taxes. The aim is to keep more of your returns working for you. A practical, boring truth: you don't need a perfect plan to start. You just need a reliable routine you can repeat. The S&P 500 is large and diversified enough to cushion the impact of any single company's bad days. Now let me outline a simple weekly routine that supports the monthly plan. Every week, spend a few minutes checking in on your account, confirming that your automatic contributions are still scheduled, and noting any changes in your personal finances. Then, go back to focus on your life. Your routine should include a quarterly check, not a daily obsession. Look at your portfolio's performance for the last 3 months, but don't react to every small move. Use it to adjust only if your goals or your life have changed. A useful habit is to set a yearly goal. For example, aim to save 15 to 20% of your income and invest that amount into the S&P 500 fund. It's not about hitting a specific score on a dashboard. It's about building a steady, lifelong habit. What about risk? The S&P 500 can be volatile, especially in the short term. Your plan should acknowledge that declines will happen and prepare you to stay the course. A good rule is to avoid debt to buy investments and to not put money you'll need soon into the market. Another practical tip is to automate your increases. Each year, you can raise your monthly investment by a small amount, like 2 to 5% as your income grows. This keeps your progress aligned with your life without requiring a big upfront boost. If you're unsure how to get started, here is a simple checklist. Open an account, pick your fund, set up automatic contributions, confirm your annual rebalancing plan, and write down a realistic savings goal for the year. Steady steps beat grand plans. There is also something called the emergency fund first, then invest rule. The fund protects you against sudden job loss or emergencies, so you won't need to pull money out of the market at a bad time. This protects your long-term plan. Let's address a common fear. What if the market falls after you start? In that case, your automatic contributions continue. You buy more shares at lower prices and reduce your average cost per share over time. Your future self thanks you for staying consistent. You might be wondering why a beginner should choose the S&P 500 specifically. It is broad, it is resilient, and it has a long history of growth, though past performance is not a guarantee of future results. It's also easy to own via one fund and requires little maintenance. If you want more protection, you can later add a small bond allocation. A typical rule for a cautious plan is 80-20 or 70-30 stocks to bonds and then rebalance as needed. But as a beginner, starting with the stock portion makes sense to learn the habit. Now let's talk about the real-world numbers. History shows the S&P 500 has delivered around 7 to 8% real returns over long horizons, though there are years of big drops too. Don't chase the exact number. Use it as a rough guide and stay invested for decades. You'll hear about diversification, but with the S&P 500, you already have broad diversification. You own 500 large companies across many sectors. That keeps risk lower than picking a few individual names, even if it isn't perfect. Another point, keep your costs the smallest possible. The difference between a 0.05% expense ratio and 0.20% can compound to large sums over 30 years. Look for the cheapest options and avoid premium advisory services, at least when you're starting. In terms of accounts, you can use a taxable brokerage account for the S&P 500 or use tax-advantaged accounts first. If you have a 401k at work, contribute enough to get any employer match. The match is basically free money and accelerates your growth. Now, one more practical idea. Automate your debt payoff too. If you have high-interest debt, your priority is to reduce that debt before investing heavily. The same discipline that lowers debt can free up more money for your investments later. If you feel overwhelmed, remember this. Invest regularly, keep costs low, and keep your expectations realistic. You don't have to be perfect to win in the long run. You only have to stay consistent and patient. Before we wrap, a quick recap of the core steps. Decide how much you can invest monthly, pick a low-cost S&P 500 fund, set up automatic contributions, and rebalance yearly. Simplicity is your friend, and consistency your ally. Now, a tiny thought experiment. Imagine a future you who started with $100 a month and kept investing for 30 years. You'd likely have a nest egg that feels respectable because you built it one small step at a time. That's real wealth, created by patience. As you build this habit, remember to keep enjoying life while saving. You don't need to give up everything you like to invest. Small sacrifices now can pay off in the long run. If you want to learn more, check your brokerage's learning resources and reputable finance sites for plain language explanations of terms like expense ratio, index funds, and dollar cost averaging. There's a lot of good material that won't confuse you. I want to hear from you. What's your monthly investment target and which fund do you plan to use? Share your plan in the comments so we can cheer you on and give you feedback. This channel aims to give you practical, boring money moves that add up over time. If you found this helpful, hit like, subscribe, and ring the bell to catch future videos. I'll keep sharing simple, actionable ideas. Thank you for watching. Remember, the S&P 500 is a long game, and small, steady steps win in the end. Like, subscribe, and comment.